Last week, I read an interesting opinion piece about one of my favorite BDCs. It proclaimed Hercules Capital growth era is over, durability remains. And I appreciate that addition at the end there about durability, because generally when we declare a growth era over, it's the absolute worst thing investors could hear. It's not wrong to think that way when your only way to make money is higher share prices. Investors must think there's more potential for the company, and that comes from a macroeconomic catalyst or that potential for growth. But for us income investors, it's just not that cut and dry. Our primary goal as income investors is that steady stream of income that we can use to supplement our lifestyle right now, or we can use to build wealth for the future. Share price gains are a nice bonus, and when they equal multiple years of income, we can cash out those shares and think of it as fast forwarding our income stream. This is a debate that I get drawn into quite often. Last year, I was on an income investing panel, and someone from the audience asked about Enterprise Products Partners. Now, you guys know that's one of my favorite stocks, so I was ready to answer this one. One of the other panelists jumped in and noted that EPD is not one of his favorite income investing stocks because the share prices don't seem to go up. I jumped in to counter, noting that that's the reason I like EPD. It trades sideways and consistent. I continue to collect my above average yield, and I can continue to buy on its slight dips. Take a look at this 10-year chart. Before the March 2020 market drop, shares had found a nice channel between $28.80 and $29.50. Since then, they have oscillated their way back above $30. And I think they're going to settle into a post-COVID channel between about $30 to $32.50. If that price channel sticks, it would equal a yield of 6.7 to 7.2%. My subscribers and I have a higher effective yield, but this is still a great range for such a solid company, and I'll probably add more shares to my position on dips that equal a yield over 7%. The global economy will continue to use oil, and oil will continue to be transported through the Permian and Delaware basins and beyond. And EPD is going to continue to collect its volume-based contract fees. I hope that EPD's dividend keeps inching higher every year, but I would be okay if it just stayed flat. Flat is not necessarily a dirty word in income investing for shares or for dividends. It could just mean consistency. It shouldn't automatically be a deal breaker. Now let's circle back to Hercules Capital. It's another stock I've been following for over a decade, and during that time, it has basically traded between $10 and $22. It seems to have found recent support around $17. I think shares could be headed into a nice sideways channel here as well. It's not a bad place to be, as shares between $17 and $20 will pay a whopping 9.4 to 11% yield. The durability is there because the majority of Hercules loans are floating with a floor. Even if we get more rate cuts from the feds, that floor prevents Hercules rates from dropping further. And actually, most of their loans are around the floor already. In fact, I think Fed rate cuts are actually going to be good for BDCs and Hercules into 2026. When borrowing money gets more expensive, aka rates go up, some companies put non-critical expansion plans on hold. They continue to reinvest, but they're more cautious. When money gets cheaper, aka rates go down, those projects sitting on the back burner get revisited. And I think that's going to mean new originations for Hercules in both existing portfolio companies and new portfolio companies. We know BDCs have been seeing higher prepayments in their current loans than usual. And I think those particular companies might take out new loans at the lower interest rate because that money's cheaper. I still think Enterprise and Hercules are great income generators for 2026 and beyond. They may trade flat for many years, and I'm here for it. I'm going to keep collecting my income and accumulating more shares on dips. You know what they say, don't throw the baby out with the bathwater. So don't let your fear of flat or stagnant share prices cause you to miss out on your next great income opportunity.